All right, we'll get started. Well, welcome everyone. I'm super excited that you're here. My name's Hannah Taylor. I'm a senior here at U of O. I'm studying business finance, and I'm one of the peer financial coaches as a part of the new UO Financial Wellness Center. This is our first workshop for this year. We're super excited to have you here to learn about loan repayment. Before we go into that and I pass it on to Ashley, I just wanted to give a little bit of an intro to the UO Financial Wellness Center, which is revamped of the financial flight plan, if anyone was aware of that before. Our mission is to financially empower students with the knowledge needed to make sound financial decisions during and after college. And as a part of this, there's just a lot of great opportunities to expand your knowledge on financial literacy, which I'll go into next. So within the events and the one-on-ones that we do, we're focused on the big five, which is the critical areas of holistic financial wellness. And those are earning, which most of that is going to be budgeting, what you're going to do with the money that you earn, spending, which is going to be managing the inflow and outflow of money, borrowing, which will be student loans like we're talking about today, understanding credit and credit cards, which I know with college students is a really big topic of conversation, and then protecting from identity theft and fraud, which in our society and technology these days, there's a lot more happening. So it's important to know about that. And then saving and investing with saving strategies and investing 101. And so the ways that we target these big five is through on-demand financial education workshops like this one right here, one-on-one peer financial coaching, which is starting to take place, and peer financial coaches will be doing so next week. And then building partnerships across campus. So for example, maybe there's a partnership built with athletics or Greek life, minority students, diversity, equity, and inclusion. There's a lot of different opportunities within that as well.
So our objectives with this training is to define what the basic loan terminology is, talk about the different steps that you will go through as you prepare for your loan repayment, talk about the different repayment plans that are currently available. We'll briefly mention how COVID-19 is affecting loan repayment right now. Also, we'll mention the cancellation and forgiveness programs that are available for federal loans. And finally, wrap it up with some tips and resources to help you along this repayment journey. Okay, so let's go into student loan basics first. So this is a little chart to help you see what the life cycle of a federal loan looks like. So first, you fill out your FAFSA form each and every year, then you're offered loans on your DuckWeb and you accept them on DuckWeb. Once that happens and you've done all your loan requirements, the loan will pay out directly towards your University of Oregon bill, and sometimes you're issued a refund to use for educational expenses. Probably everybody in this webinar right now is in the third step, which is in-school deferment. So as long as you're enrolled at least half time in your program, you are not required to make payments on your loans, unless of course you wanted to. After you graduate, that's when your grace period starts. So we'll talk about what that means in just a moment. Once your grace period is over, then you are formally in your loan repayment, and that repayment lasts until your loans are finally paid in full or possibly canceled. So there are different types of federal loans, and it's important that you know which type that you borrowed. If you're not sure, don't worry. We're going to log into the system in a little bit so you can see and remind yourself of what kind you have. If you have a direct subsidized loan, that's a better type of loan because no interest has been accruing while you have been in school at least half time. The interest on that loan starts as soon as you enter the repayment phase. You might have also borrowed a direct unsubsidized loan. This one has been accruing interest while you've been in school, so you might want to look into how much interest has accrued and perhaps start making payments on that interest so you owe less later on. There are also loans available specifically for graduate students called a Grad Plus loan, and then specifically for parents of undergraduate students, and that one's called a Parent Plus loan. Both of these also accrue interest while the student is in school. And in the case of the Parent Plus loan, your parent is responsible for making the payments on that loan, even though it was borrowed for your education. The loan is not legally tied to the student at all. So the parent can follow these steps that we're going to go over to check into their loan balances and log in and make payments and everything like that. So it might be a good idea to share this information with your parent if they borrowed that type of loan. Finally, there is a federal Perkins loan. This one we stopped making awards maybe 3 years ago or so. So you may have been receiving a Perkins loan earlier in your education. This is a different type of loan, but it also does not accrue interest while you've been in school, and interest will start upon repayment. And like I said, this loan is no longer being offered. So what is a grace period? So this is a time period where you are not required to make payments on your federal loans. It begins when you either graduate or drop below half-time enrollment. Half-time enrollment for an undergrad means 6 credits, and for a grad student, it means 5. So if you drop below that in any given term, you're technically in your grace period. On the subsidized and unsubsidized loans that probably most of you have, there is a 6-month grace period. So no payments until 6 months after you graduate. If you have a Perkins loan, it's a little bit longer at 9 months. And the grad and Parent Plus loan also have the 6-month grace period. On the parent loan in particular, the parent needed to have asked for that grace period when they did the application. If they're not sure what they asked for, or they want to get it now when they didn't ask for it originally, your parent just needs to talk to their loan servicer and they can get them set up for that. Let's talk a little bit about grad school. So if you're an undergrad now and you're thinking about potentially going to grad school in the future, you need to remember that you can only use your grace period once for your federal loans. So that means if you take off more than 6 months between the end of your undergrad and beginning your grad program, you would have already used your grace period on your undergraduate loans. Let's say you take out more loans in grad school, which most grad students do, you'll get a new 6-month grace period for your grad student loans. However, when you graduate from your grad program, you'll need to start immediately paying back your undergrad loans, even though you have your grace period on your new graduate loans. If you go right from undergrad to grad, you won't have used that grace period, or at least not all the 6 months of it. So you'll get the full 6 months when you graduate from your grad school program. Okay, interest capitalization is next. Interest capitalization is something you might have heard about in your business classes before. It means that at the end of your grace period, so 6 months after you graduate, any unpaid interest on your loans, like if you borrowed your unsubsidized or the Grad Plus loan, if you have any accrued interest on those that you haven't paid off at that point in time, all of that unpaid interest is then added to your principal balance. In essence, that means that you are now paying interest on the interest that accrued, and therefore paying more over the life of your loan. So the only way to prevent this from happening is if you make interest payments either while you're in school or during your grace period and knock that interest down to 0 so it does not capitalize. Closer to the end of your grace period, your loan servicer will reach out to you and let you know that the grace period is ending and how much interest has accrued on your loans. So that would be your last opportunity to make that payment before it capitalizes. So this is a quick visual to give you a loan repayment timeline. As you can see, you're probably in in-school deferment right now, again, as long as you're at least half-time. Then you hit your graduation date. You're in your 6 or 9-month grace period, depending on what type of loan you borrowed. At the end of the grace period, the interest capitalizes, and then you are in repayment for the life of the loan. As long as it takes you to pay back the loan, I should say. Okay, so let's talk about the actual steps that you go through in preparing for loan repayment. So there's 4, and we're going to go into more detail about each of these. The first one is to find out who your loan servicer is. If you're not sure who that is, you're in luck because we are going to log in and see who that is next. Once you're aware of who your servicer is, if you haven't already, you will want to create an account on their website because that will keep track of how much loans you have borrowed and interest that has accrued, and you can also make payments directly through the loan servicer's website. Number 2 is to determine how much you borrowed. A lot of students don't know the total of loans that they borrowed, and you might be kind of shocked, especially if maybe your parents helped you with your financial aid while you've been in school. So we are going to log in and see that total today. Number 3 is to estimate what your monthly payment will look like after you graduate. And you can also add in future loans. So if you're not a senior right now and you're going to be borrowing in future years, or maybe you're borrowing for grad school, you can figure out what your estimated monthly payment is going to be like. There's a cool tool available to help with that. The last step is to complete exit loan counseling, which we'll talk about in a little bit. Okay, so let's go more into detail on step 1, which is finding out who your federal loan servicer is. So this is an organization that collects your loan payments. So you're not making payments back to University of Oregon for your federal loans, and instead it is a company that is hired by the Department of Education to take payments on their behalf. We are going to be logging into the federal website called studentaid.gov in just a moment. And to log into this website, you need something called an FSA ID, Federal Student Aid ID. And this is the same login that you use to sign into your FAFSA each and every year. So hopefully you have your username and password. If not, you can click on the forgot information on the website and it can guide you to getting that information. Once you find out who your servicer is on this website, again, you want to create an account on their website. You want to update your contact information as well. So a lot of students, when they're graduating, they might be moving or changing their email address. And you want to make sure that your loan servicer always has the most up-to-date contact information for you. Here on their website, you can understand your loan repayment schedule. They will tell you when exactly your grace period is ending, when you go into repayment. And then number 4 is to communicate with your loan servicer directly regarding repayment. They can answer any question that you have regarding your loans. Something to keep in mind is if you borrowed any private loans while you were at University of Oregon, that would be through like a third party that you don't need to fill out FAFSA for. That will be handled directly through the company that you borrowed through. And it's totally separate than what we are talking about today, which is about federal loans. So you will have, if you borrowed both types of loans, you'll be making 2 separate payments to multiple servicers or lenders if you borrowed private loans. Before I log into studentaid.gov, I'm going to show the next slide. Which is specifically talking about if you borrowed a Perkins loan while you were here at University of Oregon. If you had a Perkins loan, the website that I'm going to show you says that University of Oregon is your loan servicer, but that is not actually correct. University of Oregon uses a company called ECSI to service the Perkins loans, and you will make your payments directly to that company. So you should have received communication from ECSI if you borrowed the Perkins loan. But if you're not sure or if you haven't received that information, you will be going to one of the websites listed on this slide to access your Perkins loan repayment information. There are 2 different websites because some are held by the Department of Education, which they are supposed to be transferring over, and most of them should be held. So most of you will probably visit the first link on this slide. But you could potentially still have your loans on the second website link here. And if you have any questions regarding your Perkins loans, you'll want to email uoloans@uoregon.edu. That's actually for our business affairs office because the financial aid office does not handle the Perkins loan specifically. Okay, so let's actually go into studentaid.gov. So once you have the website up, click the big login button. You'll enter your username and password. And the first thing that you will see is your loan totals. And this little chart here breaks it down between how much you borrowed in your principal, and then if you have any outstanding accrued interest, like if you borrow the unsubsidized loan or the Grad Plus loan, it would show that here as well. This one shows if you got any Pell Grant during your time at University of Oregon, but what we're really focusing on today is the loans. So if you're not sure who your loan servicer is, you will want to click the link that says View Loan Servicer Details. And then on this page, your loan servicer will be listed. So my loan servicer is Fed Loan Servicing. And as you can see, it has the link right here where I would go to create an account on myfedloan.org. And it also has their contact information if you have any questions. Here is where University of Oregon would also be listed if you had a Perkins loan. But remember that you're not paying that back to University of Oregon, you're paying it back to ECSI. So you'll want to visit ECSI's website for more information. So step 2 in preparing for repayment is determining your loan totals. As you can see, while we're logged into studentaid.gov is where you can also find that information. You want to do this now while you're in school, and then as you get prepared to graduate, you can view your loan totals again at that time. So on studentaid.gov, you can view the difference between the principal and any outstanding interest. Again, it also shows grant information. And then we're going to click on View Details in just a moment. And here is where you can view what type of loan that you borrowed, the interest rate that the loan was locked in for, the current loan status, like if you're in your in-school deferment right now, or your grace period or repayment status. And then also there it shows who your loan servicer is as well. So let me show you what that looks like more in detail on studentaid.gov. So I want to click the blue link of View Details. So the first thing that you might notice is I have 25 different loans that I borrowed, and that seems like a lot. So each year that you borrow at University of Oregon, and depending on what types of loans that you borrow, you might have 2 or more loans each and every year. And so that adds up quickly. And that's what that loan total is talking about. Again, it shows my total loan balance, and it breaks it down between how much of that is the principal, like the amount that you accepted on DuckWeb is what you can look at that as. And then any accrued interest as of right now. If I scroll down even more, it's going to give me the loan breakdown. So again, it tells me who the loan is serviced by, in my case, Fed Loan Servicing. There are about a dozen different servicers though, so yours could definitely be a different company. I'm already in repayment right now because I graduated about 10 years ago. So it tells me what repayment plan that I'm in. And if I click on View Loans, it gives me more detail about the date that that loan actually dispersed on, and then the interest rate that the loan was locked in for. As you can see, it says 0% for my loan right now. That is because of the special law that's in place right now, specifically for the COVID-19 pandemic. But normally my interest rate is about 6.8%. And then it has the total balance. So you can scroll down and see all of your different loans and the different information for each and every one listed here. And even more information if you click on View Loan Details again. Step 3 in preparing for repayment is estimating what your monthly payment is going to look like. So again, that information can be found at studentaid.gov. And there is a tool on there called the Loan Simulator. And on this loan simulator, you can compare the different types of repayment plans, and it helps you choose which repayment plan might be the best option for you. There's also different repayment goals. So if you're trying to pay off your loans as quickly as possible, you can select that option and it'll tell you which plan that you might want to choose, versus maybe you want to make the lowest monthly payment possible right now, and it'll still perhaps let you choose a different plan that is available. You can also simulate what loan forgiveness would look like if you're interested in maybe the public service loan forgiveness program, which we'll talk about a little bit later. You can also simulate what borrowing additional loans would look like. So again, if you're not a senior right now and you need to borrow for future years, you can add in those loans and see what would happen to your monthly payment. or if you are interested in grad school and want to look at what borrowing for grad school would look like.
Ashley, we have a question. So if their grad plan loan lists their scheduled repayment to start before they plan to graduate, what could be causing that?
That's a good question. So the University of Oregon Registrar's Office reports a student's enrollment each term to something called the National Student Loan Clearinghouse. And they do that every term, regardless of how many credits that you're enrolled in. And your loan servicer pulls that information to determine, are you at least half time? And if you're at least half time, they put you into that in-school deferment status. So I wouldn't be too weary of that date that it says now, because as long as you're at least half time, that date will keep getting pushed back further and further. And then when you graduate, the registrar's office also reports that date. And that's the date that your grace period will start, your 6 months countdown. So your loan servicer should get updated information later on when you register and begin winter term and or spring term. So I wouldn't do anything quite yet. Your servicer would notify you if they, like you're in your grace period later on, where you can contact them and say, hey, I'm still enrolled, turn in a proof of enrollment and get that taken care of. But usually it's not an issue.
And is this the same for grad plus loans?
Yes. The in-school deferment is the same, and you won't have to make payments until 6 months after graduation. And the registrar's office also reports your enrollment. Okay, so let's go back into the studentaid.gov, and now we are going to figure out what my monthly payment would look like. So I'm going to go back to the main screen here. And I am going to select on the right-hand side the loan simulator. And this is a relatively new tool, and so they're updating the website all the time. If you are not a senior right now and you want to simulate borrowing more money, you can choose the one on the right, click Guide Me to get started. Today, I'm going to select the first one. I want to find the best repayment strategy and click Guide Me. So I would suggest, if you're going through this in your own time, to answer these guided questions that it asks you, if any of these apply to you. For time's sake right now, I'm going to skip the guided questions and just show you what the end result would look like. The guided questions kind of help you fill out this information here on the right side, like your personal information, your loan information, since you're already signed in, should be accurate. And then your repayment goals, you can update these. Again, you can choose you want to pay off your loans as quickly as possible, lowest paid amount over time, your lowest monthly payment, whatever your goal in particular is going to be. So as you can see, based on what I have selected right now, this is the repayment plan that it is suggesting to me, the extended fixed repayment. And we're going to go over what these different repayment plans mean in just a moment. But you can see that it gives you what your monthly payment is going to be, and then what the total amount paid over the length of time that you're paying your loans will be, and including any interest that you're paying. And then when it estimates you will be 100% paid off on your loans. What I would suggest is filling out more of the personal information if you skip that step, in particular what you think your adjusted gross income is going to be when you graduate. So when you get hired for your first job, hopefully you have some idea of how much money somebody in that field makes as an entry-level position. To give you an idea, I'm going to put $40,000 on here and apply changes if you make any changes there. And then you can see once I entered an income on there, it actually suggests a different repayment plan to me. In this case, the revised pay-as-you-earn plan. Most of you, based on your time when you entered your undergrad program, will probably qualify for the pay-as-you-earn program listed here. And this is usually what your lowest monthly payment is going to be, and the lowest total amount that you will pay over the whole time that you're paying back your loans. As you can see, the payment is lower than the other plan that it gave me originally, and I'm paying back less and paying it back in a quicker amount of time. And there's also a forgiveness amount built in here which we will talk about as we talk about the plans later on. One last thing that I want to highlight on the loan simulator is that if you are interested in the Public Service Loan Forgiveness Program, you can check this little box. It's by default, it's off. You can change it to on and apply changes. And then it will simulate what paying for only 10 years on your student loans looks like and how much would be potentially forgiven by the federal government after you complete your 10 years of service. And as you can see, my forgiveness amount went up quite a bit by doing that. So you can play with that tool as well. So I would definitely come back to this throughout your time at University of Oregon, and then also when you're graduating, and your information might change. You can see that it asked about how many is in your household. That information could definitely change if you get married or have a child or something like that. All of those things affect what your monthly payment looks like. So that tool is there to help you to simulate changes in your situation and which plan might be the best for you. If you have any questions about that, your loan servicer can also help you make the decision about which payment plan might be best for you. Okay, the final step in preparing for repayment is to complete your exit loan counseling. So when you first took out federal loans, you had to do your entrance loan counseling session online, and that talked about your rights and responsibilities for borrowing loans. But now that you're going into repayment, the exit counseling will focus on helping you pick your loan repayment plan, talking about what your monthly payment is going to look like, and also some budgeting exercises for you. So if you borrowed any of the federal direct loans, which is the subsidized, the unsubsidized, or the Grad Plus loan, your exit counseling is required within 30 days of graduating, leaving school, or dropping below half-time enrollment. Again, you will go to studentaid.gov and sign in to complete your exit loan counseling. If you also borrowed a federal Perkins loan, there is a separate exit counseling session specifically for that loan, and you will be contacted by ECSI about 4 months after leaving school with the particular link to complete the exit loan counseling for that online. That one is super important that you get it done on time, because if you don't, they will put a transcript hold on your account, meaning that you can't request any transcripts until it's completed. So if you need to apply for grad school or send that to an employer, you can't do that until you do your exit counseling first. Okay, so let's go ahead and talk about the different repayment plan options that are currently available for borrowers.
Ashley, one quick question. For credits considered half-time at U of O?
Half-time for an undergrad is enrolled at least 6 credits per term, and then half-time for a grad student is enrolled at least 5 credits per term, or for a law student is 5 credits. Great question. So the different repayment plan options. So these first 3 that are listed, in particular the first 2, are available to pretty much anybody that borrowed loans. The first one is usually the most popular plan, and it is the plan that your account will default to if you don't formally select a different repayment plan, and that's the standard repayment plan. What this means is that you are paying a fixed monthly amount, equal same amount each month for 10 years. And at the end of 10 years, your federal loans will be 100% paid off. So if you're looking to pay your loans as quickly as possible, usually the standard plan is something that you would want to look at. The next is the graduated plan. So this assumes that maybe when you graduate, you get your first job, it doesn't pay as much as you would like, but maybe every couple years you get a pay raise, or you are going to be promoted in your position and you can afford a little bit more in your monthly loan payment. So it will start out with lower payments, and then each 2 years your payment amount will go up. And so your last 2 years you're paying quite a bit more than when you started per month. This one also, like the standard plan, means that your loans are 100% paid off within that 10-year period. The last one, the extended plan, is only available if you borrowed more than $30,000 total in federal loans. You can choose if you want your payments fixed, like the standard plan, or if you want them graduated to go up every 2 years. And this one extends your loan repayment from 10 years to 25 years. So you have longer to pay your loans, which is going to equate to a lower monthly payment, but the longer you take to pay your loans, the more interest that you're paying on those loans. So keep that in mind and use that loan simulator to help you determine, if you're extending your repayment, how much more interest are you paying over the life of your loan? And is there a better option for you? The next 4 plans that are available are all considered income-driven repayment plans. And they are called that because they're based on the amount of income that you make. So in that loan simulator tool, you can see that I entered an adjusted gross income, an estimate, of course, of what a student might make when they graduate. And that's what it based my monthly payment on, is that amount of income that I entered. So you can play around with it and enter different amounts of income and see what your monthly payment would look like. So if you sign up for one of these plans, they will ask for your tax information to determine how much income that you made. So the first one, pay as you earn, is what most students in this webinar today will qualify for. You had to have borrowed not before October of 2007 in order to qualify for this plan. So payments on this are going to be based on your income and also on your family size. So if you're married or have any children that you support, your monthly payment will probably be lower because of that. So they take your total tax information and then they figure out what your discretionary income is. So they, of course, allow you to have some money to pay for your rent or mortgage and your utilities and your food and everything like that. How much money is left over after that, and take 10% of it, and that's what your monthly loan payment is going to be. With any of these income-driven repayment plans, it could change your monthly payment amount if you are married. In the case of this plan, only if you file your taxes married filing jointly would they look at your spouse's loan debt as well as their income. However, if you file your taxes married filing separately, they would not. So depending on if your spouse borrowed loans or what their income looks like, that also could affect your monthly payment. So that's something that you would want to look into if you're married or plan to be married soon before choosing this plan. The next one is revised pay as you earn. It's very similar to pay as you earn. It's the newest repayment plan that's available. Again, payments are 10% of your discretionary income. Really, the only difference here is that your spouse's income information will always be considered regardless of how you file your taxes. The next 2 are income-based repayment and income contingent repayment. These are repayment plans that are a lot older and therefore not as popular. Sometimes they will equate to a higher monthly payment because they might be looking at 15% or 20% of your discretionary income as opposed to 10%. If you can afford more than the pay-as-you-earn plan is telling you that your minimum monthly payment will be, I would suggest maybe signing up for that plan and then making extra monthly payments towards the loans that you want to target specifically, as opposed to setting up one of these that's going to have a higher monthly payment and apply to all of your loans equally. But of course, that's something that you can talk about in a one-on-one meeting with someone in the Financial Wellness Center, or talk to your loan servicer about which plan is the plan that's right for you with your circumstances as they are right now. So some important considerations to look at when you're picking your loan repayment plan. If you choose any of those last 4, the income-driven repayment plans, be aware that they do offer taxable loan forgiveness, either after 20 years of payments or 25 years of payments, depending on which plan you're on, and then if you borrowed for grad school or not. Most plans are going to be 20 years that you're paying, and if there's still anything left after 20 years, that would be forgiven, but it's considered income and therefore taxable on the year that your loans get forgiven. They do require that you certify your income annually. So your loan servicer will send you a reminder each year and ask you to use the online tool to share your tax information with them. And if you don't do that, they will kick you out of the income-driven repayment plan and then put you into the standard plan. So your monthly payment could go up quite a bit if you don't remember to certify your income. And then finally, they may consider the income and student loan debt of your spouse, which we did talk about. So look into that on studentaid.gov, there's a lot more information about the different repayment plans available to help you make that decision. Some general loan repayment considerations. Everyone, if you are able to, should sign up for the auto debit program on your loan servicer's account, meaning that they will take your monthly payments directly out of your checking or savings account. And if you do that, you actually save a 0.25% off the interest rates of your loans. So you're saving money just by signing up for auto debit, and then you don't have to remember to make your monthly loan payments taken out automatically. You can switch loan repayment plans at any time, but be aware that there could be terms or conditions or hidden outcomes of you making that switch. In particular, I found that out the hard way by, I was in one of the income-driven repayment plans, and then I switched to the newest one, the one that had just come out, because it would give me a lower monthly payment, which I thought was a good thing, and it was, but then my loan balance went up by $4,000 overnight. And when I called my loan servicer to ask why, they said by voluntarily switching out of the income-driven repayment plan I was in, the interest capitalized the outstanding interest on my account. So it was added to my principal, and that's why my balance went up $4,000. So that was definitely a shock, and nothing I could do to go back and undo that. So talk to your loan servicer before just simply logging in and making the switch to a different repayment plan. They make it very easy to switch, but they don't necessarily highlight all of the terms and conditions before you do so. So I would suggest calling your loan servicer and talking to a human first. Lastly, keep documentation of everything. So usually your loan servicer is going to communicate to you through their website by sending you notifications, which then also sends you an email that there's something in your inbox on the servicer's website. That information only stays on maybe a year or 2 years before it's deleted from their website. So I go in periodically and save all of those PDFs onto my computer. So I have all the information that they've told me regarding my loans in case I need to refer back to that later on. I want to briefly talk about loan consolidation because it's a question that we do get asked if we would recommend a student consolidating their loans. Usually it's not something that we do recommend anymore because the federal government makes sure that most students only have one loan servicer that they repay their student loans back to. Back in the day, you might be making 5 different payments to 5 different servicers, but that's just not the way things are anymore. Luckily, they've made it easier for borrowers. So if you do consolidate your loans, basically you're taking all of those individual loans that you have and turning it into one new mega loan. And they are combining the interest rates for all those individual loans into one new interest rate and then like slightly rounding it up a little bit. It also might qualify you to extend your repayment term. So instead of paying your loans back over 10 years, you might have up to 25 years to pay your loans back. Which could result in a lower payment, but again, probably more interest that you're paying over the life of the loan that you might need to be. You can find out more information about loan consolidation at this website and find out more information about the pros and cons and see if it's something that you might be interested in. This is different than private loan refinancing. Private loan refinancing is something that you would do through a third party. And that means that usually you would have had to borrow a private loan in order to qualify for it. But you can actually consolidate your private loans and your federal loans into a new private loan. And they'll give you a new interest rate for that private loan, which is certainly an option that some students take. But remember that because your loans then are no longer federal loans, that you don't get any of the federal benefits. You lose out on the grace period, you lose out on potential benefits. Like right now we have the COVID-19 benefit of everyone receiving a 0% interest rate. You wouldn't have gotten that if you refinanced your loans and have them through a private lender. So definitely read into all the terms and conditions before doing a private loan refinance. Okay, I want to briefly mention what is going on right now about the CARES Act. So I mentioned a couple of times that the federal loan interest rate is currently set to a 0%. This is temporary. It started in March 13th of this year, and it ends at the end of the year, at least currently, unless it's extended. Including any in-school status loans, everyone's interest rate has been set to 0%. So nobody is accruing more interest on their loans right now due to the pandemic. So they're automatically placed into an administrative forbearance, and payments are not required for anyone that's already in repayment. The studentaid.gov website does have a lot more information about the pandemic and how it is affecting federal student loans, so you can read all of their announcements for up-to-date information. Okay, so let's talk about the forgiveness and cancellation programs that are available for federal student loans.
Ashley, we got a quick question really quick. If your parents took out a PLUS loan, is there a way to transfer that to the student after the graduation?
That's a great question. Unfortunately, no, there is no way to transfer the Parent Plus loan to the student's name legally. A lot of students and parents tell us that the student will be making the payment for the parent on the loan, which you can certainly work out something like that. However, legally, the loan will always be in the parent's name. And the parent does have different repayment plan options available to them. The Parent Plus doesn't qualify for all the ones that we've talked about today. So they will want to log into their own studentaid.gov and find out more information about what their monthly payment looks like and what plans they qualify for.
And then one more question. So as of now, the 0% is through December 31st. Has there been any talk on if that might be extended?
With the new administration that we're about to have come January, it might be, but of course we won't know until it happens. A lot of people are supporting it being extended. It actually was set to expire in October, and then it got extended to the end of the year. So, you know, it definitely could happen. And then you won't, of course, be required to make payments if you're graduating at the end of fall term here coming up. So that's just something to look into. But your loan servicer will communicate with you. I've been receiving emails directly from the Department of Education about all of this going on. So they will keep in contact. Okay, so talking about loan forgiveness and cancellation, what that means is that if you meet certain qualifications, the Department of Education will cancel all or a portion of your federal loans, meaning that you don't have to pay the rest back. And that would include any principal that you borrowed, as well as the interest that has accrued on the loans. So there are different types of forgiveness and cancellation programs, the most popular being the Public Service Loan Forgiveness Program. There's also teacher loan forgiveness and the Perkins loan cancellation. So public service loan forgiveness, you have to meet 4 qualifications in order to get your loans forgiven. The first one is to be employed full-time at a public service job. And what does a public service job mean? Usually that means working for the federal government in some capacity, or working for a 501c3 nonprofit organization. There are other organizations that qualify though, and there's a tool that helps you determine if your employer qualifies actually that I'll mention in just a moment. Step 2 is that you have to be enrolled in an income-driven repayment plan. So it's any of the last 4 that I mentioned on the earlier slides. The goal, of course, with the loan forgiveness is that you make the minimum monthly payments that are required, and you pay the least amount possible and get the most forgiven by the federal government. So if you signed up for maybe the standard plan, your loans would already be forgiven in 10 years. So paid off in 10 years. So there would be nothing left to forgive at the end of that 10-year period. So you don't want to sign up for the standard plan if you're looking to get public service loan forgiveness. You probably want to sign up for the pay-as-you-earn plan if you qualify for that one. Step 3 is you have to have qualifying direct loans. So the subsidized loan, the unsubsidized, Grad Plus, or if the parent is working in public service themselves, their Parent Plus loan can qualify for this program as well. Perkins loans are not included in this program unless you consolidate your loans into a new loan, then they would be, because it'd be a new direct loan that qualifies. Step 4 is to make 120 on-time monthly payments or 10 years of payments while you're employed for that public service employer. They do not have to be consecutive payments. So if you work 5 years in the school system, take a break and then work another 5 years, you would still qualify. So once you do all of those steps, if you still have any remaining student loan balance, it will be forgiven by the federal government. And the best part is that it is tax exempt. So it is not considered income and you do not have to pay taxes on it. Remember that when we talked about the forgiveness program earlier, you had to make 20 years of payments and it was still taxable at the end of that. This is only 10 years of payments and it is not taxable. To get started in this program, once you're actually employed by a public service organization, you will complete the new PSLF certification and application form. You can find this form at myfedloan.org, which is Fed Loan Servicing's website. Fed Loan Servicing is the one federal loan servicer that handles this forgiveness program. So once you fill out the form, they will determine if your loans are eligible and if your employer is eligible, and then start counting your payments towards that 120 goal that you have. And your loans will be transferred over to Fed Loan Servicing if they are not already your servicer, so they can manage this for you. You can also use something called the PSLF help tool, and you can find that at the studentaid.gov/public service website. And this help tool is where you can enter your employer, and it actually has a database available to tell you if your employer qualifies for this program or not. And it helps you fill out the form. You can get that printed and then you turn it into your employer to sign off to certify that you are employed there, and then turn that into Fed Loan Servicing. myfedloan.org has a lot more information as well as that studentaid.gov website if you're interested in this program. Here's the help tool that I mentioned. Again, it's studentaid.gov/public service. The second program available is teacher loan forgiveness. So on this one, if you're planning on being a teacher, you have to teach full-time for 5 consecutive academic years. And it has to be in a low-income elementary or secondary school, or perhaps an educational service agency. So if you teach for 5 consecutive years, it is good for direct, subsidized and unsubsidized loans, or also if you were a student quite a while ago, there was a different program besides direct called FFEL loans. Those qualify for this program as well. Any plus loans, the Grad Plus loan or the Perkins loan, do not qualify for this program. Most teachers will get $5,000 forgiven on their loans. Although if you're a secondary math or science teacher or a special education teacher, that amount can go up to $17,500 since those teachers are more in demand. To find out more about the teacher loan forgiveness program, you can visit the studentaid.gov website to find the terms and conditions.
Ashley, one question about previously the public service loan forgiveness, a few aspects of it. One, how easy is it to qualify? Would be the first one, then I can ask the other two.
Sure. I guess it depends. So as long as you're meeting these 4 criteria that are listed, you will qualify. So it's just the matter of going into the PSLF help tool and seeing if your employer and your loans match with what is required to get this. This program started in 2009, I want to say. And so 2019 was the 10-year mark when people could first start getting their loans forgiven. So we were all waiting with bated breath to see if this was actually going to happen and people were going to get their loans forgiven. And the ones who met the criteria, they are getting their loans forgiven. So it is a legitimate program. 10 years ago, they had really bad misinformation about how to qualify for the program. And so that's why you saw in the news that a lot of people aren't getting their loans forgiven in the program. That's why they have that PSLF help tool available to make sure that folks know what steps they need to follow now. So as long as you're following the program, you can get your loans forgiven. So in that terms, I would say it's easy.
Perfect. And then with that, just clarification, you have to currently be in the position before you apply. And
That is
then,
correct. Yeah, so you can use the help tool now to see if your potential employer does qualify, to make sure, before you start the job. But you can't actually turn in that form until you have your employer sign off that you are currently employed there. So you can't turn in the form until you're employed.
and then if you switch jobs, can you apply again, or is there multiple times that
Yes.
you can?
So They do suggest that you fill out that form with your employer at least once a year so you can count your new payments that you've made while you've been employed. And if you're switching employers, absolutely have your previous employer sign off on it now so you can get your time recorded and your payments recorded. So there's no questions later. And then at the end of the 10 years, you don't have to go back to that employer that you were with 8 years ago and try and get this form signed. So you can switch and then just have your new employer fill out a new form for you.
Thank you.
Yeah, of course. Okay, the last forgiveness program is actually Perkins Loan Cancellation. So only a few borrowers qualify for this program. You have to serve full-time in certain occupations as the ones listed here on the screen. Up to 100% of your Perkins loan can be canceled. And cancellation amounts vary depending on which job that you have, and it could be increments. So if you work 2 years, you get 15% of your loan forgiven. Another 2 years, you get 30%. So it just depends. The website listed here on the screen has a lot more information about which occupations qualify for the program and what you have to actually do to apply to get cancellation. Again, the Perkins loan is handled by the UO Business Affairs Office, not the Financial Aid Office. So you'll want to call them with any questions or visit their website for more information. Okay, so lastly, let's talk about some tips and resources for your loan repayment journey. One positive of paying your loans back is that there actually is a tax benefit available for some borrowers. So if you pay more than $600 in your student loan interest in any given calendar year, your loan servicer will issue you a statement that looks like this. It's called a 1098-E form. It's similar to the 1098-T form that U of O sends you each year to determine how much tuition you paid in the last year. But this form actually lists how much student interest you paid in the last year. So this is a copy of mine from last year. So you can see I paid almost $2,300 of interest. And I got to deduct that from my adjusted gross income on my taxes. And anytime you get a deduction on your taxes, it means you're going to pay less in taxes. So if you get a 1098-E from your loan servicer, make sure to enter that on your taxes to save money, as long as your adjusted gross income is $85,000 or less in a year. If you ever have any trouble making payments, the first thing that you want to do is contact your loan servicer. They're there to help you. There's different options that they can suggest, perhaps switching your loan repayment plan, perhaps switching the due date of your payment. So you want it as soon as you get paid, taken out of your account and not at the end of the month. They can do that for you. They can, perhaps you are unemployed, like a lot of people are right now, and you can't afford your payments. They can put you into a deferment status so you don't have to make your payments for a given amount of time. Depending on what your income is, your estimated payment could actually be zero on some of these plans. So definitely talk to your servicer about all the different options that are available to you. What you never want to do is just not make your monthly loan payment and not talk to your servicer, because that is when default happens on your loans. So if you don't make payments for 270 days in a row, you're in default. When you're in default, the federal government will begin garnishing your wages from your employer. They will take your tax return refund if you are issued one to put towards your loans. It also destroys your credit report if you're in default and you can't borrow more for school if you return to school. So you don't want to be in that situation. If you can't afford what they're telling you your minimum monthly payment is, talk to your servicer for options. Also make sure that you avoid student loan scams. A lot of people get phone calls, emails, letters, texts saying that there are federal loan relief programs available. The Department of Education never charges application fees or maintenance fees or anything like that to help you with your loans. Your loan servicer is there for you absolutely free of charge. And then any of those forgiveness and cancellation programs that I mentioned today are available free of charge. If you're hesitant about anything that you receive, call your loan servicer directly. Never give out your social security number or your login information to anybody over the phone or email. It's probably a scam. This is my last slide. So a recap of what we talked about today. Number one is to visit studentaid.gov when you have some free time and review your borrowing history there, and also estimate what your monthly payment is going to look like, and then keep going in and revising that information periodically to determine if anything new has happened, how that's going to affect what your repayment looks like. Number 2 is to create an account on your loan servicer's website if you haven't already, to track your student loans and reach out to your loan servicer with any questions that you have. Number 3 is to identify what your repayment goals look like. Do you want to pay off your loans as quickly as possible? Do you want to look into that public service loan forgiveness program a little bit more? And then use that loan stimulator tool to help you with those goals. And number 4 is to schedule a one-on-one appointment with someone in the Financial Wellness Center team. And I'm going to kick it over to Hannah now, and she has a couple more slides and can tell you how to schedule an appointment.
So thank you, Ashley. Hopefully everyone has taken something with them or steps that they can take after leaving this, so that they can get a kickstart and set themselves up for a good future to pay off their loans and be in a good position moving forward. All right, so with the Financial Wellness Center, just a way to stay connected with us is through financialwellness.uoregon.edu. On there is where you can sign up for more workshops and opportunities like this, and also where you can sign up for one-on-one peer coaching with those 5 areas that we talked about earlier. So if you're having problems or want to learn more about earning, spending, borrowing, protecting, saving, or investing, we would love to have a conversation with you. We're here for you. We're here to help you. And we want to help build and improve the conversation around financial literacy on our campus. We want all of us as Ducks to just have a good basis for where we're at now, but also moving forward, as these are skills and information that we can take through for our life. You can also email us at financialwellness@uoregon.edu if you have any feedback on today or anything that you'd want to see moving forward. And then with social media, you can find us at UOFinAid on Twitter, and then you can find us on Facebook and the same handle for Instagram. And then we would love it if you subscribe to UO Financial Wellness on YouTube.